following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it's Friday, and we're going to be talking about money. I want to start the program by telling you I had a guest that I had talked to about being on the program. He had been on the program a number of times before, I think once or twice before, has a very, very interesting story, and had a very big announcement to make, and was going to make that announcement on the radio. And I've been waiting for this to happen because he was waiting for everything to be approved by regulators and so on. It was supposed to happen today. It was supposed to happen on the radio show. He talked to me early in the week and said he was ready to do it. And I had another guest lined up. We moved that guest to a different time slot, and I was going to have my guest on the radio. And I forgot to confirm it with my guest. He's now in Eastern Washington and in a meeting and can't be on the show. But I'm going to tell you about his company and about something that's very, very big that's happening. That's coming up later in the program. But I'm also going to take the time to introduce you to a couple members of the staff at Adams Financial Concepts. They're going to be my guests today. You're going to hear from two of them. So that's probably worth more than anything. But I wanted to start. I want to talk about a number of things. One, we're coming to the time of year when you get all these predictions of what to do with your stocks next year, what to buy, what to sell, what mutual funds to move into, move out of, and so on. I'm going to talk about that some later in the program. But I wanted to start and talk about something that started way back in 1957. Almost 60 years ago. 60 years ago next year. Ken Olsen and Harlan Anderson. They were engineers at the MIT Lincoln Lab. And they were working with machines where operators had control over the programs. And they had a business plan to make these machines and put these machines out to different people. But they could get no interest. No one was interested in funding a computer company. Can you imagine that today? No one being interested in funding a computer company? There had been some small companies that had tried and failed to make computers. RCA and GE had tried to make computers. They couldn't make a profit. And yes, you had IBM that was beginning to make computers, but nobody was really making much headway. At the same time, there was a professor George Doriot, who was a professor, became a professor at Harvard in 1926. He founded a company called American Research and Development Corporation, ARDC. And prior to ARDC, the way that most companies gained funding was through angel investors. Same as we have angel investors today. Somebody makes a lot of money, or family has a lot of money. They'll put up money for new companies to start. I started my career in the aluminum industry, and there were two people that started on the path to make aluminum around the same time, Hérault in France and Hall in the United States. It's called making aluminum is a Hall-Hérault process where you're passing a large electrical current through a cryolite bath and making aluminum from that. That was something that was funded in the United States by the Mellon family. The Mellon family had a significant amount of money. They gave $25,000, which was a huge amount of money in the late 1800s, to Hall to build a small aluminum aluminum smelter, and that's how Alcoa got its start. That was the way that most companies got external funding. They would go to a family, they would go to an angel investor, they would get the money and put it together. But Dorio had a different idea. He brought together a number of people who themselves probably could not fund an entire company or several companies. He brought them together into a company called ARDC, the American Research and Development Corporation. They pooled their money together, and they were the first investors into this small company. They put $70,000 into this company that was going to make computers. It was a company that was called Digital Equipment Company. Today, actually, you can see those computers, but that's another thing. They put $70,000 as an initial investment into the Digital Equipment Company. And yes, you can see a digital equipment computer if you go to the Computer Museum in Seattle, down on First Avenue, right past Macarena Bakery. There's a computer place. It's hard sometimes to find, but if you go in, you'll see a DEC computer. You'll see what computers used to look like, even back to the time when they had punch cards. Digital Equipment Company, they put $70,000 into digital equipment. And when digital equipment came public, that $70,000 was worth $38 million. $70,000 investment became worth $38 million. And that was the birth of venture capital. That launched the venture capital industry. That was the key thing. The American Research and Development Corporation, ARDC, became the grandfather company of venture capital. If you look at the impact of what venture capital has done, the numbers I have are going just to 2007. They're old and they're probably much larger today. But the companies founded by entrepreneurs and funded by venture capital in 2007 produced 10.4 million jobs. In 1 year, 10.4 million jobs. You talk about the news that came out today or this week about employment, 178,000 jobs. Now that's a net. That's not the gross number of jobs that were created. There's a lot more jobs that are created, but there's jobs that are eliminated. The net was 178,000. Think about what venture capital did. Just in 2007, 10.4 million jobs. Not only that, those companies generated $2.3 trillion in revenues. 18% of GDP generated from those companies that were financed by venture capital. That's 2007. It's more today. In 2007, more than 20% of R&D was done at those small firms. And of public companies founded since 1979, since 79, there were 1,330. 43% were financed by venture capital. Those public companies, 57% of the market capitalization of those companies founded since 1979, 57% funded by venture capital. They have 38% of the employees of those public companies and spend 82% of the money spent on R&D. You know a lot of the names, Apple, Microsoft. Those were companies financed by venture capital. But large companies, as venture capital has grown into an industry that's funding almost $40 billion a year today, they fund primarily larger companies. They're looking for companies that are trying to raise significant amounts of money. We talk about the unicorns, those private companies which are valued at $1 billion or more. Private companies, prior to coming public. There's over 100. There's approaching almost 200 of those unicorns. Just a few months ago, we had OfferUp on this program. OfferUp is the first Seattle unicorn. They don't like to talk about it that way, but that was the value. They got funding from venture capital that put them at a valuation of the company of $1 billion or more. Those things are happening. Those are venture capital companies. But smaller firms have struggled to find financing. 1 out of 100 firms only finds funding. But something is going on. Something is really going on. The world is beginning to change, and the funding is beginning to change. If you look at that period of time from 1982 to 2000, when we saw the Dow go from 1,000 to 10,000, grow tenfold, a lot of that financing, a lot of the financing of those companies came from venture capital. I believe that we're in a super cycle, and we're seeing companies, and we're on the edge. We're beginning to move up since 2009, and we're seeing a new method of financing. We're still seeing venture capital, but venture capital is beginning to level out. We're seeing something new happen. We're seeing something that only a few years ago didn't exist, and in my opinion, will be, and the forecasts are, it's going to be even greater than venture capital. Now we're coming up to a commercial break. Don't go away, because I want to tell you what that's going to be. And that also has something to do with a guest that won't be on. Hang on. I'll be right back after the commercial break. So don't go away. We've got a lot to talk about.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about venture capital and how it got started, where it is today, the fact that, and the numbers I have go to 2007, so they're old numbers, but in 2007 alone, they created 10.4 million jobs. The companies created $2.3 trillion in revenues, 18% of GDP, and over 20% of all money spent on R&D came from those companies. They create jobs, they created technology, companies that you know, but today they focus more on large companies. So it seems very appropriate today, not just because that I was going to have a guest that I screwed up and didn't get corrected on, but because of the change of administration. I think the greatest accomplishment of the Obama administration will not be healthcare, will not be some of the other things that have been done, but one particular bill that was passed in 2012 called the Jobs Bill. Doesn't pertain to jobs as you think of jobs, but jobs stands for Jumpstart Our Business Startups. And what it is about crowdfunding for individual investors. With as little as $1,000, they can invest in crowdfunding. In fact, even less than that can be invested, and they can have ownership in companies. They can do it anywhere in the world, and anybody in the world can invest. And there's now over 2,000 crowdfunding sites In 2010, total crowdfunding raised $880 million. Not very much, less than $1 billion. By 2014, it had grown to $13 billion. By 2015, to $34.4 billion. And today, this year, it's expected to raise more money than venture capital has raised. Now, a lot of it is going in peer-to-peer lending. We had a peer-to-peer lender on the program. He talked about the lending and how they set things up with algorithms and the returns they're getting from peer-to-peer lending. But a significant portion is growing as part of equity into startup companies. By 2025, the estimate is that crowdfunding will supply $300 billion to companies. $300 billion. Venture capital today is supplying $30 to $40 billion. Crowdfunding will supply $300 billion. You know, that's a significant impact into the money that's funding technology, funding small startups, and funding those companies which are beginning to change our life and will continue to change our life. Everything from robotics to the foods we eat, to the clothes we wear, to the restaurants we eat in, to the whole supply chain that's going on. Technology. We're going to see dramatic changes. And if you look at one specific area, if you look at computer chips, the power of a computer chip is doubling every 24 months. If you look at the cell phones we have, which are basically small computers, there's more computing in a cell phone today, in a smartphone today, than there were in those big IBM computers of the 1960s. More computing power than the big, huge computers they were producing in the 70s in that small smartphone that we hold in our hands today. Computer chips are doubling in power every 24 months, and they're coming down in price by 50% every 24 months. But if that's significant, think about one other area. Bioengineering is doubling 5 times as fast as computer chips. Bioengineering, doubling 5 times faster. That means it's doubling once every 4 months. Once every 4 months. That's bioengineering. And that was to be my story, because my guest today was to be a company by the name of Blue Marble. My guest was to be Colby Underwood. And we've been waiting for all the regulations to be put away and everything gone away. I was telling friends, I was telling business associates he was going to be on the program. I told everybody but him. Everybody but him. I realized that about half an hour before I left to come here to do the program. I realized I didn't confirm with Colby. And Colby is on his way across eastern Washington because their plant actually is in Missoula, Montana. And he was leaving from headquarters here in Seattle to go to Montana. So here we are. And he had a conference call this afternoon at the same time. So my mistake, my huge mistake, but I want to tell you what's going on with Blue Marble. It took, when we talk about oil, we've talked about peak oil, we've talked about oil prices. It took bacteria a couple million years to take degraded foliage, degraded organic material to produce the oil that we now drill for. Bacteria that took them a couple million years to produce that. What Blue Marble has done is they started out, and Blue Marble was on the program. Colby was on the program a couple years ago. They started out in biodiesel and realized that biodiesel and diesel fuel is a low-margin, high-volume product. And they turned instead to focus on high-margin, petroleum-type products that were small volume but large margin. And they took a bacteria from the stomach of a whale, and whales eat plankton and so on in the bottom of the sea, and they combined it with the bacteria from the stomach of a cow, which eats grass and grains, and they made bacterias which actually will work on waste materials to produce food, fragrance, and flavors. The 3 F's. They'll take a waste material from a brewery, what's left over, and they'll produce products which could be used in perfume, which could be used in juicy fruit gum, which could be used in toothpaste. They can make, using the special bacteria, they can produce petroleum products, and they can do it in a matter of days instead of a matter of millions of years. They have a plant that's up and running in Missoula, Montana. They're looking at other expansion places. And this week, they got the approval to do crowdfunding. They're in the process. They'll begin the process of raising $80 million. Now, as I talk about Blue Marble, I'm not making a recommendation for the stock. I believe there's high risk involved, and it's only something that someone would invest in if they could afford to lose the entire investment. So I'm not making a recommendation. I will say that, and I do have to disclose that I will eventually own, I do not own today, but I will eventually own some of the stock, and I will, for the right clients, recommend it for my client portfolios. But it's something that is very highly risky. It's not something for everyone. But it is something that I believe is on the cutting edge of bioengineering. Now, with the Jobs Act of 2012, Jumpstart Our Business Startups, it allowed crowdfunding at 3 different levels: a Tier 1, a Tier 2, and a Tier 3. Tier 1 crowdfunding is under $1 million, and that is for companies that are raising a very small amount, and the regulations fall to the local governments. Tier 2 falls to state governments. Those are fundings that are less than $40 million. And over $40 million, those are companies which can raise money, and those are regulated by the SEC. Those are the regulators that have to approve this. In the case of Blue Marble, they're raising $80 million. And it's something that is a first for the state of Washington. Maybe it's one of the first in the entire United States. The final regulations did not come out until May of this year, so it's a recent thing. And yet, if crowdfunding is one of those things that by 2025 will raise $300 million, what we're seeing here in the state of Washington is something that's extraordinary and very special, and it's something you should follow. The purpose of this program is to bring you, the listener, put you ahead of the curve, to make you ahead of the curve, so that you know what's going on and you're there before. You're ahead. It's to inform you about industries, about companies, about what's going on in the economy and in those industries, so that you can be ahead and not just following on. This is one of those things with crowdfunding. It's a breakthrough, in my opinion. It's something that's marvelous and very, very highly risky. It's not for everyone. It's something that if you do decide, and if you do have an interest, you can contact Blue Marble. Do the due diligence. Be sure that you do the due diligence. Be sure you read all the materials. Be sure you're aware of all the risks that are involved. Be sure that you're completely informed. Check all the documents you need to check. Don't take my word for it. You have to do it on your own. That's where it is. And yet, be aware that this is the beginning of a number of companies that will come down the line in the state of Washington, in California, on the East Coast. We're just seeing the beginning of bioengineering. It's growing 5 times faster today than computer chips. That is very, very significant. We're going to come back, and I've got a couple guests to introduce you to, actually a couple members of our staff, our team at Adams Financial Concepts. So don't go away, and we're going to talk about 2017. I'll be back after this break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Well. Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So welcome back. Did you ever wonder how we put together these radio programs? How it all comes together? I mean, I sit here and I talk for a long time, and it takes me about 7 or 8 hours to prepare for each hour of program. But I just do part of it. There's other people that are involved. You know, Mike Prentice has been doing some of the producing. Now it will fall to our administrative manager, Sara Kraft. And I want to introduce you to Sara Kraft because she's here. And if you ever wondered, because we tweet during the entire program, that's not me who's doing the tweets. That's Sara. Welcome, Sara.
Thank you. A little peek behind the curtain. Yep, I'm sitting here and tweeting out blurbs like one takes notes in a college class about what Mike's saying. And I do it off the cuff, actually. He doesn't let me cheat and see the notes beforehand.
So, but it's good. A couple times people have responded to the tweets.
Yes, we do get a little bit of response, and it's always nice to see that people are paying attention.
I hope so.
I will have you know, I put a lot of thought and work into 140 characters.
So Sara came from Minnesota.
University of Minnesota, Minneapolis.
And has been doing the office administration, does an incredible job.
Oh, thank you.
Today I had lunch with a banker who said when he called in that she was really remarkable on the phone.
Yes, I can definitely text Mike and let him know you're going to be a couple minutes late. Don't worry.
So that's Sara, who is helping to put together the guest, who puts together and corrects my blogs, because I write blogs, and she goes through the blogs, she corrects them and makes them sound like I'm halfway intelligent.
He puts together the ideas, and I make sure the English is legible. And we also have been putting together a YouTube channel, so you can listen to all of About Money Radio over on our YouTube channel, About Money Radio, on YouTube. You can just type that into the search bar, or it's youtube.com/aboutmoneyradio. We've got a gorgeous new logo, so you can sit and stare at that. And yes, it's an unmoving picture with Mike's voice for 45 minutes. You're welcome.
Wow.
Sara has done that, and she also takes care of the website. So Sara's an amazing person.
Aww.
Very, very happy to have her as part of the team.
Thank you.
One of the other members of the team is Paul Birney. Welcome to the program, Paul.
Thank you, Mike. It's good to be here.
So,
I have to tell you one thing, Mike, and I want to share this with the audience. I'm sitting across from you here in a beautiful radio studio, looking at the gray sky, and something that absolutely stands out like you cannot believe is Mike's tie. And it made me stop and think that we have a season to celebrate, and we're here to talk about money because it's about money, but it's really about Mike's tie. So Mike's tie is red and green with a reindeer. It's red with a huge green Christmas tree, and there's a reindeer in front, and the reindeer is pounding on a drum set. And
he also looks like he can play electric guitar.
Yeah, so we have a rocking reindeer. And I guess that ties into where what we want to talk about is it's not only a holiday season and a time to celebrate, but it's a time at the end of, pretty much this is the end of everybody's fiscal year, and it's an opportunity to evaluate their portfolios. So I just want to talk to you a little bit about what happens when someone calls the office at 206-903-1019 and asks for a free portfolio analysis, which I know you're happy to do.
You know, it begins by almost the same routine each time. It begins with me telling whoever's sitting down in front of me a little bit about Adams Financial Concepts, that I've been in the business for 30 years, that I have my own approach to doing things, I have my own way of doing research. And then I want to talk about the person who's there. And I want to talk about their values, about their objectives, about their tolerances. But it's more than about money. It's more than just how much risk they can avoid. It's about them in large extent.
Right. So you want to focus on what their needs are, what their future is,
and what their dreams are. And
right.
One of the questions I will sometimes ask is, if you were told you have only 1 year to live, what would you do?
That's a huge question.
And it's a question that I think gets people to thinking about, what do they want to do with their life?
What's one of the most interesting answers you received when you asked that question? Is there anything you can share?
There's a couple that I can really remember. There's more than one. There are some people that will say, I don't think I would change anything that I'm doing. And I'm thrilled when they do that. And then I can remember somebody saying, you know, I've always wanted to go to Ireland.
Okay. Me too.
Yeah,
said,
I'm with you.
Yeah, let's go.
Why don't you go?
Right?
Well, I can't really afford it. I said, wait a minute. You're telling me that with this portfolio,
and it was
you
pretty
can't
good
afford
size.
it? And it was a fairly good size portfolio. Well, yeah. I said, you should go.
Right.
Forget about investments. This is something that you've been dreaming about. And it was a lot longer answer than what I just gave, but it was a long answer.
Right.
That they've been thinking about this from the time they were in grade school. For 50 years, they've been dreaming about going to Ireland. And
I hope they went. Did they go?
they did.
I was really impressed the other day. We were interviewing some prospective clients, and you had one guy, he said, oh, I'm thinking about retiring in 2 years. And you gave him, a really logical, a conversation with him that was about prioritizing then being able to afford to retire for, the prospective 30 years that he was probably going to be in retirement. Whereas there was a younger guy, I think he was about 35, he just had 2 kids, he just bought a house, and he was talking about how much money he still wanted to put into his portfolio. And you said, well, no, take a step back and think about it. You've got 30 years to save for retirement. Don't give up what you want to do now and the things that you're prioritizing right now and look ahead to retirement. Worry about those things as they come. And I thought you would hear so many investment advisors, I think, say, no, put more and more and more in because they get more money out of it. The more that goes into that portfolio, the more money that you as an advisor get. But you actually sat down and you understood what he was saying. And, as somebody who's sitting alongside you, I went, oh, yeah, he cares. God dang, look at that.
Well, we all know Mike cares. He cares about the ties that he wears.
I have 14 Christmas ties,
You
so I
have
have a different
14?
one every day.
So we have, I know you wore one yesterday, so we have about 12 to look forward to.
The
Well,
12
I've
days
been
of
wearing a few
Christmas
every
ties.
day. Yeah, but anyway. Yes.
So now you know what you're getting from Sara and me this year for Christmas, right? Yeah, a Christmas tie.
God dang it, you spoiled it.
So
No, it's important to talk about life in total. It's
Right.
not just about how much money and what you do with money. And yes, I always love it when people want to give me more money because I make more.
right.
But what really counts for my clients, and I have a very high retention rate. When I look at the retention of most financial advisors, they turn over 10 to 15% of their portfolio of their client base.
Right.
We turn over very few every year.
Yeah, that's great.
It's because we really do care about them, and we care about their total life. And for me, it's not about the money. It's about life. It's about children. It's about, when you look, and I now have grandchildren.
You do have grandchildren.
I have a 3-month-old.
It's about having fun.
A 15-year-old, a 12-year-old.
12-year-old?
A 15-year-old, and an 18-year-old.
How about your 3-month-old?
And my 3-month-old.
Yeah. Let's not forget about that.
So, it's about children and living life.
Yeah, and you have to plan for them, right?
You do.
It's a big part of it. Multi-generational families.
And I had lunch yesterday with a guest that's going to be on the radio show.
Who's that?
Her name is
Jamie.
Jamie Hills. And she has a business taking care of disadvantaged children, or not disadvantaged, but children who are premature or who are autistic or whatever. And you realize all the pains that go on. And I said, she had questions whether she should be on the program. And I said, absolutely, because what happens to those children when the parents pass on? The parents have to plan for that. And very few parents really plan for a child that's going to have significant problems.
For sure. Right.
And so it's an important part of talking about younger people with what they're doing with families, talking about older grandparents, what they're doing with their grandchildren and their children.
You got to have the resources.
Absolutely.
And financial planning is a big part of that.
It is.
And running a portfolio the right way, which is what you do.
It is. Thanks for the question. I never talk about that on the radio.
You're welcome.
But I also know that most of my clients really don't accept mediocrity. They don't accept average. They hire me to do an outstanding job. And they hire our team to do outstanding work. And that is part of what we deliver.
Along with outstanding ties.
We're coming back to a break, and don't go away, because I do want to talk about the year end and the beginning of the new year. I'll be right back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So Nate Silver wrote a book called The Signal and the Noise, Why So Many Predictions Fail and Some Don't. Nate Silver achieved a lot of fame when he predicted accurately how the election would go for Obama when he was elected in 2012. And in 2016, a lot of criticism because the polls showed that Clinton was going to win, Trump did win. And so a lot of people looked at Nate Silver saying, you got it wrong. Actually, he didn't get it wrong. When you hear the weather forecast and they say there's an 80% chance of rain, and you look out the window and you see it raining, they got it right. But they didn't say 100% chance. They said an 80% chance. That means there's a 20% chance it's not going to rain. And so people look at the weather and they say, you projected rain because you said 80%, but it didn't rain. So you had to be wrong. No, they weren't wrong. They said there was a 20% chance that it was not going to rain. And so it was with Nate Silver when he said that the probability after the FBI came out with their thing, the probability of Clinton being elected had dropped from 80% to 65 or 70%. That meant that there was a 35 to 40% chance that Donald Trump was going to be elected. The odds favored Clinton, but still, there was a high probability that Trump would be elected. Lower probability than Clinton, but it wasn't insignificant. It wasn't a 100% prediction that Clinton was going to win, and he turned out wrong. He predicted that there was going to be 65 or 70% Clinton, and the difference was to Trump. And Trump won. He uses the Bayes theorem, which I also have to say I understand. It's a probability model where the things continue to change based on new information. As things become clear, as things begin to change, you change the probabilities. And oftentimes I explain it by poker. If you think about a poker hand, whether you play poker or not, you can understand this. You start with 52 cards. They're from ace to ace, king, queen, jack, down to 2. The best hand is a straight flush where you have, or a royal flush where you have the ace, king, queen, jack, 10 of a particular suit, spades, hearts, diamonds, or clubs. You can have 4 of a kind. But in a game called 5-card stud, where you're dealt 5 cards, you're dealt 1 card which no one else can see, so it's a down card, and then the next card is dealt face up, so everybody can see the second card that's dealt. The probability changes once you can see those other cards. If you have an ace that is down, so no one else can see your ace, and you look at the table and 3 other people are dealt aces face up, you know that you cannot even get a pair because there's only 4 aces in the deck. You know, you can't get 3 of a kind, you can't get 4 of a kind of aces because you can see. If you can see 3 aces, your probability of getting a pair is 0. Probability of getting 3 aces is 0. The probability of 4 aces is 0. Before you see those cards turned up, if all you see is the down card you have, the card that no one else can see, if all you can see is an ace, the probability that you're going to get a pair, the probability you get 3 of a kind, or the probability you get a 4 is not 0. But it changes once you can see other cards. That's what Bayes' theorem says. That's how Bayes' probability works. So it's a constant change of what's going on. That's how Nate Silver forecasts things. You hear a lot about sabermetrics in baseball, Michael Lewis wrote the book called Moneyball and talked about how sabermetrics is changing the name of baseball because people look at the stats. They look at on-base percentage. They look at other numbers besides the average that a person hits the ball and ERA, and they look at other methods or other stats about a person to determine their worth. That's all based on Bayes' theorem, and other theorems as well. But anyway, that's what he does, and that's how his predictions changed. And as he got new information, the probabilities changed. So as we look forward, as we look into 2017, and we begin to look at what's going to be happening, it's probably the most difficult time, and there's less information on what this administration is going to do than any other administration I've ever seen. And I've been around a while. I've been in this business for 30 years. And most of the times when you have a change of administration, when we changed from Bush to Clinton, when we changed from Clinton to Bush, when we changed from Bush to Obama, you had an idea of where they were going because they laid out, this is what I promised to do. And we have a number of promises from Donald Trump, but we also have some things where he's changed his mind or his advisors are changing. So forecasting where things are going is very difficult. So I come back to that time, the 2 days before the election, Monday and Tuesday, before we knew that Trump was going to be elected, the market was up 400 points. On the 2 days following the election, when Donald Trump was elected, the market was up 400 points. That's because the economy doesn't turn on a dime. It's like a battleship. If you're changing the course of a battleship, it takes time to make that change. It takes a lot of area to make that change. And so it is with the economy. Now, at the same time, when you look at what's going on in the market today and the gains that have been made, there's certain areas in which the stocks have truly gained. Some of those are the financials, some of those are healthcare. There was concern because of Dodd-Frank, and maybe the Dodd-Frank's going to be modified or go away, and that's going to give banks a lot more leverage. Interest rates are going to rise. That also is going to help the banks. That was going to happen no matter who was elected. Healthcare. There was a lot of concern over drug prices, Valiant and some of the others that raised their prices dramatically. There was a feeling that had Clinton been elected, that there would have been pressure on drug prices. Instead, the feeling is that may not happen. And Obamacare is going to be modified and could be repealed. All of that has an impact, and people are beginning to forecast. But I want you to think about one thing. Tetlock has done a study, and he found that the experts are usually no better than a dartboard. He's been doing forecasting and evaluating forecasting since 1987. And what he's found is that if you look at people and their forecast, that 15% of chances that people say have no chance of ever happening actually do happen, and 25% of things that people say you can count on, they're table pounding, you can just absolutely count on, absolutely fail instead. So as we go into this new year, you have to be very, very careful on what you hear and evaluate and think about what you've heard in the past by those same experts' forecast and how accurate they've been. That wraps it up for today. Next week, we got more programs coming, and I will not foul it up. We will have our guest. But having Paul and Sara was great anyway. Thanks, Paul and Sara. Thanks for being on the program. And until next week, have a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's